Hello, welcome to the Real Estate Regroup Show. I am your host, LJ Walker, a real estate investor presenting information that will shift your thinking on how you can own a home or invest in one. Today's episode, I'm going to be telling you about different ways in which you can have your money grow so that you can have a sizable down payment and money for closing. I want to just preface to say that I am not a stockbroker, financial advisor, or accountant. I am just here to help those who are aspiring to own a home. First, let me give you a little bit of background about myself. When I graduated college, I was lucky enough not to have any loans that were due. Thank God I was able to receive a couple of scholarships, and I also worked some summer jobs, which helped me pay off everything. However, during that time, there was a recession, and it was very hard for me to get a job. So I ended up temping a lot. And one time I actually had two temp jobs at the same time. Later on, I landed one permanent job that paid more, but I saw that this still did not help. Even though I was saving and cutting costs, the money was growing really, really slow. So what I did was I went to the library and I read a whole bunch of financial books. And one of the books that I've read was The Black Woman's Guide to Financial Independence, Think and Grow Rich. Both the original one by Napoleon Hill and Think and Grow Rich, A Black Choice by Dennis Kimbrough. I also read a lot of Susie Orman books. In addition to that, there was a lot of TV shows and radio shows back then about how to manage your finances. Many of these TV shows and radio shows, unfortunately, they're not around anymore today. In reading these books and watching these shows, what I found is that rich people, they don't just work to make money, but they find ways to make their money work for them. So they make money while they sleep. In reading all of these books and finding out how did they go about doing this, this is one of the things. These I'm going to list several things that I found. Number one, when choosing a bank, besides its convenience, you want to see what is the minimum required, what are their fees, what are their interest rates on the different products that they have. At that time, money markets and CDs were paying the highest. As a matter of fact, you could get a CD that would pay you 5%. Unfortunately, in today's market, it's a bit disrespectful, in my opinion, and the rates are extremely low. So if I was doing it today, I would use online banks because online banks, most of them don't have any fees, or if they do, it's very, very low. If you want to see what banks, how much they charge as far as fees are concerned, and also how much are they giving towards interest, you can go to bankratemonitor.com for comparison. The second thing that I noticed, they used to break down the different investment vehicles, and that time it was mutual funds, stocks, and bonds. I chose mutual funds because I like the fact that when you buy a fund, one fund can invest in like 20 different stocks or 20 different bonds at one time. So that attracted me to that because I was always brought up that you don't put all your eggs in one basket. When I was choosing a mutual fund, from what I read, try to choose those that charge less than 1%, those that did not have MB1 fees, those whose managers managed it for a good period of time, meaning 5 years or more, those who also had a good track history of 10 years or more. Well, for me, my preference was 10 years. And I also looked at their performance, meaning being that I came out of recession when I was in college, I looked to see how they did when it was at its worst. And then when the years got better and the economy started to recover, I saw how well they did during that recovery stage. So if they went down 8, they had to come up 16. They always had to do double, as in the better years than in the poor years when I was choosing a mutual fund. Later, I expanded my knowledge and I found out about ETFs. ETFs are electronic traded funds. They're very much similar to a mutual fund, but they trade like a stock and their fees are a lot lower. So I began to move my money in that particular area. And then I also invested in tax-free municipal bonds because those were normally sponsored by the state. After buying the home, what I did was I kind of got tired of trying to keep track of all my finances, so I went ahead and I got myself a financial advisor. Unfortunately, all financial advisors are not created equal. I lost a lot of money when I put my money in the hands of those who were quote unquote professional. I found that I did a whole lot better than they did. So for today, what I would mention, because they didn't have this back then, is I would take advantage of the free financial advisors that don't get any kickbacks from any of the funds. And this is something that I didn't know way back then, and I found out the hard way later on. Also, back then, there was no Facebook. Today, there is Facebook, and there are some Facebook groups that will help you with learning how to invest. So because of that, there was a point in time when I did lose money on a real estate investment, and I joined Club Millie. Club Millie is now the Black Billionaires Club. However, ERGJ Enterprises, who heads that up, I believe he is open to helping everyone, and I believe he charges now $5 for anybody who needs some financial advice, who supports his Facebook page. As a matter of fact, Wanda Fields and Erica Padmore, all of us were actually in Club Millie when it was a little bit more active, and we all benefited from being in that particular club. Wanda Fields also was in a group called the Abacus Group, which also strives to help African Americans improve their financial literacy. And I noticed that there are other people from Club Millie that have went to that club, and they are also doing quite well. So I would say, check out those groups, check out any other groups. Of course, do your own background check to see which one you're more comfortable with. But I can definitely attest to the fact that ERGJ Evan Jefferson, who also, by the way, has YouTube videos, studying under him, I learned a little bit more and I gained a lot more as well, as far as how to choose stocks and how to choose mutual funds. Being in the group while I was there, I found another platform called Motive Investing. And you can reach them by going to http://r.mtf etfs.io/ABIDN. It's free to join, and it actually offers you ways in which you can make money for free. The way it does this is that you can set up your own motif, which means you can set up your own ETF. If someone else buys it, you get paid. You can also, they provide you a referral link, and if anybody joins uh, through that link, you also get paid that way. However, if you want to buy any of the ETFs, stocks, mutual funds, IPOs, or in the IRA, there is a minimum for investment. The minimum for the mutual funds ETFs is $300. I forgot how much the others cost, but it definitely is a lot cheaper than your typical brokerage firm that's out there. Next, another website that I found was Stockpile. And you can go to http://www.bit.ly/2WSTDYZ. For $5, you can invest in fractional shares. Now, let me tell you what I did. A couple of years ago, I think it was 2017, if I'm not mistaken, Black Panther came out. And I saw people posting about how wonderful of a film it is and how they went back again to see the film. So what I did was I looked to see who made that film. I noticed that the film was coming out during Valentine's Day. So I created an ETF around Black Panther and Valentine's Day. I also, on motif, I also put $5 into an account of the company that produced the film. And I made a sizable amount it came out in February. I would say by May, I more than tripled that amount. Well, way more than tripled, because we were looking more at $300. So I turned my $5 into over $300 within a 3-month period. I think that was pretty good. Next, many of you are familiar with Stash, which is also allows you to invest for $5. It is free to join for those people who are under 25 years old. And if your account is more than $5,000, it's $1 a month fee that you get with that. The website there would be http://bit.ly/2VDOKWH. The next one that many of you know is Acorns, which also lets you invest for $5. It's free for college students for 4 years, and they do have REITs that you can invest in. Next, there's a platform called M1 Finance. It's also free to join. It's only $100 to start investing, and you invest in fractional shares. Now, in order to borrow, you have to have $10,000 in that particular account. I personally did not invest in M1 Finance. I don't have anything against it. The only reason why I'm bringing it up, because it is free to join, but because I already have Stash and Stockpile, and I'm already in Motif, which does fractional shares, I didn't feel like I needed another one. The next platform to look into is Betterment. There's no minimum requirement to invest. They do also have a referral fee that they will pay you every time you refer somebody to their program. And if you put $5,000 into your account with them, they give you free tax advice, which I think is wonderful. The website is https://www.betterment.com/? referral underscore key equals LELI T as in Tom, H as in Harry, Walker. The next platform is Wealth Simple. They want $10,000 for tax advice, but it's very similar to the way Betterment is set up. Next, another popular one that you may have heard of is Robinhood. Robinhood, it's $2,000 for stocks, ETF, cryptocurrency. They have free option trading and it's commission free. So it's a very broad platform that's out there. Next, you have Wealthfront. Wealthfront, you have to pay $500 to join, and there's a 25-cent fee. Next, I would say this is the most risky of them all, and that is Lending Club. Lending Club is http://lclub.co/5ca9b555. The reason why I say this is risky is because you're dealing with individuals, and what it is you are the bank. They say that they'll create a profile claiming that they need this much money to borrow. You lend them that money, they pay you back with interest, but you're dealing with people. This is not FDIC insured. You really don't have any type of protection. Many of the other platforms, yes, there is a risk in them. Oh, and by the way, before I forget, Motive Investing is actually offering market CDs. Market CDs pay more than the CDs that you purchase through the bank. The only catch is with the market CD, it is $5,000 minimum. They're going to open that up June 28th. I will say this. When you're investing in the market, it is risky, but here's what I found. Even though you lose money sometimes, you normally gain that money back, especially if you're in it for the long haul. And what I found is that the money that I have in the bank, it really, 0.005 for a long time now. A few of them are paying 1%. Even with me losing money in the market, I still make more in the market than just having it sit in the bank. I mean, it's just really ridiculous. So that is definitely something to think about. I would definitely, I gave you all these links and all these different platforms to look into. Some of them are free. I would say go to the ones that are free first and play around in that area. Learn as much as you can. And then when you are comfortable, invest. And like I said, Stash, Acorns, and Stockpile, out of all of these platforms, they're the cheapest. They're only $5 to invest in a share. So that's really not that much money if you really think about it. And you'll be surprised at what you can get. And the other advice I say to you is this. I noticed that our inner city youth, they know what's hot. And when they catch on to something, especially those in New York, Philly, and LA, when they catch on to something, the whole world starts copying them for some reason. I don't know why that is. When it comes to music, when it comes to even movies such as the Black Panther movie that I mentioned before. So whatever your kids keep talking about and is raving about, I would take that $5 and invest in whatever company produced that product that your kids are interested in. And I'm pretty sure you will definitely make money off of that. As a matter of fact, many companies now have, I don't remember the exact name, but they have this new department within the advertising department, the advertising division, and they're called the Cool Factor. These are individuals that they pay $70,000 to go to inner city neighborhoods to see what the kids there are into and what they are interested in. So there is money. We have the money. We have the brain, or we have the essence, but everyone else is profiting off of us, and we're not we need to learn how to profit off of our own intuition, gut, taste, etc., because everybody else in the world is. And then finally, I want to tell you to make sure you check my previous videos on my YouTube channel, which is called Real Estate and Recreation, because on there I discuss different grants that are available to first-time home buyers, to people who are disabled, to single parents, etc. So get in where you fit in and see which grants apply to you, and you should go ahead and apply and get those while they're still available, because some of them actually have already expired, unfortunately, due to the president that you have elected. Um, but there are some that are still in effect. So I hope this information has inspired you to reboot your mind, reset your focus, and make smart financial moves. Feel free to pass it along. Remember, each one, reach one, teach one. Bye for now. Until next time, have a good night.